The world's two largest economies will dominate from a top-down perspective in the coming week. China will publish its latest Purchasing Managers' Indices, or PMIs, for manufacturing and non-manufacturing industries on Wednesday the 30th of September. This will be the latest opportunity for economists and investors to assess how this country's economy is bouncing back from COVID-19 and its spring lockdown. Remember that a reading above 50 is indicative of growth, one below 50 suggests a slowdown or even a recession. Now, whether you choose to take the readings completely at face value, I shall leave up to you, and the long run of manufacturing scores just above 50 may look suspiciously uniform to some, but last month the readings were 51 for manufacturing and 55.2 for non-manufacturing. Then, on Friday the 2nd of October, we will get the latest update on the American jobs market with the publication of the non-farm payrolls number, which shows how many posts have been added or lost during the prior month, excluding the agriculture business. Now, the decline in the number of new weekly unemployment claims seems to have stalled in the past few weeks, getting stuck at just under the 900,000 mark, although the good news is that's well below the spring peak of 6.9 million unemployment claims. Now, this suggests the US labour market is stalling a bit, perhaps as a result of fresh local COVID flare-ups and lockdowns, so the new non-farm payrolls number should be interesting. In April, America recorded the loss of 20.8 million jobs, and it's clawed back just around half of those in the next 4 months, although again the pace of recovery has been slowing, with August's initial reading coming in at 1.37 million new job additions, and that's your benchmark for comparison with the new figure on Friday the 2nd of October. Back on the home front, there'll be lots of corporate news to digest, as there's a lengthy roster of scheduled announcements, especially from mid to small cap stocks, although a few FTSE 100 firms will be updating their shareholders as well. Names which may be worthy of further research, either on their own merit or because of what they have to say about the wider economy, include the following, although do note some of these dates may still be subject to change. Newspaper and online publisher Reach on Monday the 28th. Greggs, Card Factory, AA and Hotel Chocolat on the 29th. Catering giant Compass, Under Fire fast fashion group Boohoo and Topps Tiles on the 30th. Litigation funder Burford Capital and floorings expert James Halstead on Thursday the 1st of October. And to close, logistics group Wincanton on Friday the 2nd of October. But the company which may be most capable of causing a fuss in the week ahead is Ferguson. Once known as Wolseley, whose vans you may still see driving around the UK, the FTSE 100 firm is due to report full year results on Tuesday the 29th of September. Shares in the plumbers merchant have recovered pretty well from their spring stumble and are almost back to their all-time highs, and a quarter higher than they were a year ago. The share price rally reflects a recovery in trading, a pattern confirmed by July's fourth quarter trading update. Ferguson gets nearly 90% of its revenues from America, with the rest coming from Canada and the UK, after 2017's sale of the Scandinavian business, and this has probably helped to fuel the share price rally. One positive indicator for Ferguson has been a recovery at the number of permits for and starts and sales of new houses in America. As a result, sales in the USA were down just 0.6% year-on-year in the fourth quarter, compared to an 8% drop in Canada and a 29% plunge in the UK. That kept the drop in overall group sales to just 3.6%, only a modest deterioration relative to the third quarter slide of 2.2%. With those trends in mind, analysts will then assess the headline profit and dividend figures. For the full year to July, the analyst consensus forecast for what Ferguson calls ongoing profit is $1.6 billion, pretty much flat with the prior year. That translates into an ongoing, or perhaps underlying, earnings per share figure of $4.85 against $5.17 a year ago. In the probably unlikely event that Ferguson Chief Executive Kevin Murphy feels confident enough to offer any guidance for the new financial year just begun, analysts are looking for flat ongoing profits at $1.6 billion again. In terms of the dividend, like many other FTSE 100 firms, Ferguson did declare a dividend for its fiscal first half, only to then cancel it later. The firm also scrapped its share buyback programme at the time in April. Intriguingly, analysts have Ferguson returning to the dividend list with a second half payment, which matches last year's figure of around $1.45, or about 112p a share. Shareholders will also watch out for any update on the plan to demerge the UK activities, which would leave Ferguson as a pure play on North America, and also a plan for a proposed secondary listing of its shares in the USA. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.